Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You are listening to Money on Tap. My name's Seth Krussman, and guess who, folks?
I'm Ben Brayshaw.
Yes, there it is. Thank you very much. You're welcome, Ben. And I'm glad that everybody here with us today is excited to be here and be talking about, well, I know you're at the edge of your seats and you can't wait to find out what it is that we're going to talk about. But before we talk about what we're going to talk about, I'm going to tell you, you can reach out to us at 855-226-8551 or info@yourmoneyontap.com. This is the home of three-dimensional investing, where you can come talk to the professionals and you can get some experience and in what it means from a financial planner's perspective to take a look at you as your whole person, your whole plan, and the big picture, and try to find that right fit for you in what works to create that plan. That's the three-dimensional perspective here. And that was a little long-winded approach to say that it's going to be a great show. We're going to have a lot of fun. We've got a guest on here with us today. Glen Dorsey from Clarke Capital is going to join us, and we'll do a little bit more of an introduction down the road here with him. But before all of that, how rude. How
You're monopolizing the mic a little bit there on me, Seth.
I have not even said, how are you, Ben?
I'm doing well. I guess you're really too excited to get going today. Wow.
This is I can't really edit Ben on the, I'm just.
A little bit of Seth ADD going on over there. I'm not sure.
It's how I make sure that the production quality of the show stays appropriate and where it should be.
Keeping me in line? Are you keeping me in line,
keep
Seth?
Talking. Yes, I do. Hey, well, I'm glad you're doing good, Ben. I'm going to step back off the mic for a minute and let you Ben, you just take it.
Well, I got to tell you, Seth, I'm pretty excited about my new wireless keyboard that I got for the radio studio.
I did not see that coming.
You did not see that coming.
No,
I'm very excited. For all the people who know, we got a new radio studio. We're pretty pumped about that.
I have a stapler.
You got a stapler for the radio? Good for you, Seth. Good for you. No, we got a great show for you guys today. Glen Dorsey, Clarke Capital, just a wealth of knowledge, been in the business for a very long time. Don't want to expose any age here out of just general courtesy, but he knows his stuff, and I am super excited about talking about inflation and bonds and making money when people aren't. I think that's going to be a very good conversation with him. And
I think he looks about 20 years younger than you would think when you hear his resume of where he's been and what he's done. And I wonder if there's something about that. Just, people that are in this industry, they just continue to be able to maintain that youthful vigor and that appeal. Whereas if we were attorneys, after 15 years, you might think we're, ready to retire.
Yeah. No, he definitely looks good for his age. So yeah. Poor Glen, when he gets on, I have him all embarrassed here. So, but before we get Glen on, before we get going, and before we dive right in, we've got for you Money in the News.
All right, all you chess players out there. This is great news. It's good news for you as a chess player, and it's also really great news for anybody that has the younger generation behind them, to give even more reason for why you might want to be teaching children to play chess. Now, a recent study has shown that this is from a trio of researchers from Monash University, Deakin University, Developing Economics of Assad Islam, I think.
I love dropping the really hard names on you, Seth.
Ooh, you just left that one for me, didn't you? It's perfect. Teaching kids to play chess found it decreases risk aversion.
The article's by Bob Eureka.
Yeah, that was too easy. I want to talk about what risk aversion really means. And if you're not familiar with this term and why we're even bringing this up and why we're excited about it, is risk aversion is the tendency for people to prefer outcomes with low uncertainty to those outcomes with high uncertainty, even though the average outcome of the higher uncertainty is equal to higher monetary value than the more certain outcome.
If you're driving in the car and you just listen to Seth, I'm sure you have no idea what he just said.
Do you like more money? Then get that higher risk outcome that's going to get you that more money. That's the ticket. But most people want to get the sure thing.
Okay, Seth, for all those listening, let's just explain exactly what he just said. If you learn chess, you're going to be able to deal with risk better. For Seth, for all your Greek.
Yeah.
What I did like about this article, and the ability to evaluate risk, which was really what was interesting in this article, was that children learned that taking bad risk really was not of any value, and they learned that practice to just kind of dismiss that. I thought that was great.
Yeah, not all risk was the same, right? There was like sacrificing things haphazardly was what they talked about, but calculated risk, sacrificing the knight to be able to progress the game was a good thing, and they were able to do that. And it was interesting that it also had a lasting effect on them. Like they were continuing to be able to carry that over years later. It just wasn't during the time that they were playing chess.
All right, to jump out of the chess match world, Seth, two other articles here. One is Blackstone. This is a Bloomberg article. Blackstone bets billions, B as in boy, billions on reopening and travel revival. This is by Heather Perlberg. This is an April 22nd article. They're reporting this article. Blackstone invested $17.7 billion. That's billions. I mean, that's a lot of billions right there. In the first 3 months of the year this year, buying hotels, including Extended Stay America, private jet operator Signature Aviation, and UK travel company Bourne Leisure. This is a major, major investment in the reopening play, and honestly, a pretty large gamble. I mean, not that I'm not for the reopening play, Seth. I mean, we've made money on that. I mean, that's part of what the investment side that we've actually benefited from in our portfolios. But this is a huge, huge bet. What are your thoughts?
Like you said, Ben, at what level we've consistently tried to have some real good conversation around. Like, let's stay grounded on this thing as long as we possibly can. But I think it's right. I do. I think that there's a lot of opportunity there, and I think also one of the things that the average investor just isn't probably going to be able to hold on to is the timeline here. When you're talking about $17.7 billion and working in that kind of framework, you got time. And that's part of it. Is you want to be a ways ahead of the money and the assets, the way the money is going to move. If you're in for the long term, that's great. That's what you should be. And that's really, I think, a great indicator here. Some of the things that I'd like to take away here is what are they taking a look at as far as moving the dial for them? And they're looking at slot machines. Going back to record levels in Las Vegas, not just the bookings of travel in the UK and other places in the world too.
Well, I think there's a lot to be said about the reopening play, but I think they do note in the article, and I honestly have to tell you that I have these questions and these things that I'm looking at when I'm looking at different holdings, assets, and stocks and companies and ETFs that maybe work in this space. How does the social distancing and the restrictions on all of that, how is that going to impact everything? Because I got to tell you, my wife and I are talking about vacation and places to go and things to do. And we were talking about like the big parks and the Disneys and the Six Flags and stuff like that. And, I was talking to my brother-in-law, and I think a day in a park wearing a mask all day long, having asthma and everything else in my life, like to me, that's a deterrent. These are real questions you have to ask. It's not a political conversation. It's just those are the realities. And how many people are not going to be going places and doing things because of whatever restrictions they're either avoiding, whether you're for it or against it?
There's a lot to be said there. And actually, Kira went to Boise, Idaho here. And this is a couple of months ago now. But it was a part of the reasoning there was they were looking at going to Mexico. And it was like an $800 test once you got off the plane at Mexico. So they were going to get their cheap flight, but they were going to get their money sooner or later from you on that testing, on getting off of the airline. But, in Boise, nobody's wearing masks. They were going about life as is and washing hands and I think being cautious. Very different place. And I was just talking to somebody the other day that did a cross-country road trip, and it was, coming out of Portland, which is super restrictive. The rest of the country just isn't doing these things, and they're doing it very differently.
Oh, yeah. I mean, I skied once this year. I'm a huge skier, avid skier. New Hampshire came up with some crazy rules, and then the ski industry made it worse. I was at Pat's Peak for all those people who are local, and I was skiing down and pulled my mask down helping my daughter, and we were skiing alone, no one within 30 feet, and the ski patrol people were screaming at us. And I was like, what is going on here? I mean, there's nobody with it. I mean, I'm outside in the middle of nowhere, 30 feet, maybe more. I'm helping my 10-year-old daughter, and I was like, forget it. I'm done. I'm not skiing here ever again. I called the manager. I said, listen, what is wrong? I mean, you want me around social distancing, all these things. I'm willing to conform, but when I'm skiing and I'm exercising, I need to take a breath and no one's around me, I don't need someone screaming from a distance. I mean, it was a totally crazy scenario. I chose to never ski there again for the rest of the year.
This is interesting. We've all now gotten like these unlicensed hall monitors out here telling everybody what to do.
Yeah, but you know what's funny is I wear a mask skiing. It's a ski mask. If you want to pull it down because you want breath, there's a reason why you did. Here I'm dragging my 10-year-old daughter. I'm like, this is crazy. No matter where you stand on this, these are the decisions and the things you got to think about when you're making an investment. And they're pointing this out in the article. They don't understand exactly how America is going to respond to this because everyone's all over the place on what they personally feel like they're comfortable with. And even whether you're vaccinated or not vaccinated or whatever that story is for you, that doesn't mean you're going to be comfortable with someone not wearing a mask or wearing a mask or what's required, or if you're comfortable being 3 feet away or 6 feet away based on it's crazy. And I don't even know how to evaluate it.
We got to get to the next article here, folks, because it is just adorable. This wonderful little lady just did a sight unseen move to Arkansas. A friend of hers sent her over an apartment, and it happened to be a retirement home that she moved into.
This is a little weird. Go ahead, Seth. I'm sorry.
It's just the most adorable thing. Yeah.
Maddie Ann, she's 19 years old, was moving to Arkansas from Oklahoma, and she literally, sight unseen, rented this place. And it turns out that it was a senior citizen home. She didn't realize in moving in that she just thought there was a lot of older people living there. Turns out she's actually a nurse of some sort for older people to boot at 19, which is interesting. She must be an LNA. It doesn't specifically speak to that.
Yeah, God had a better plan.
Yeah, well, then anyways, it was on TikTok because she was so embarrassed by the fact that she didn't even realize it and moved into a retirement community that she put it on TikTok and she had more than 2 million views. And then people started questioning, how could you not have known that? And it turns out there's an equal opportunity housing scenario going on that age is not an issue. They have to make it available to people who are younger. What's really funny, though, I think we both noted it in the article.
Oh, the comment of, that's great, but seriously, why would you move to Arkansas? That was more interesting.
That was more of a question mark for them than the nursing home.
On purpose. Yeah.
So I'm like, okay, well, that's a good one. But she's only paying $350 a month.
For a 2-bedroom.
2-bedroom.
I'm moving to Arkansas.
I know. I'm reading the article. I'm thinking to myself, hey, listen, I don't know that I want to move into a retirement community. She loves them. She loves her neighbors. She said she can play music really loud. No one cares because they can't hear. I mean, there's all these very funny stories. She's, bingo and everything else. But I don't know that I want to move into a retirement community, then to move out and then just one day move back in.
This is really, really early retirement. I don't know how many people really thought that seriously about it.
No, I know. Well, that's going to do it for us. Money in the News. Thanks for listening to that. We'll be right back with our friend Glen Dorsey from Clarke Capital. Glen will be joining us. You're listening to Money on Tap. You can reach us at 855-226-8551, and you can email us at info@yourmoneyontap.com.
Hey, folks. Seth Cressman, Brayshaw Financial Group is our company, and we bring to you Money on Tap. I say we, that's Ben and I. We have a lot of fun doing this show. And one of the things that we love about doing Money on Tap is that our goal for you to have access to the financial planning world. How do we think? What are we doing? What are we talking about? Raising the bar of your financial education. it's so critical. And that's what we're doing here. The other side of this is as well, we're financial planners. If you are looking to work with a financial planner, if you want to have that playbook for you to understand the important things right now and how you're going to get to your goals or how you're going to retire successfully, that's what we're doing as well. If you have $250,000 of investable assets, give us a call. It's free to you, and it is worth your time to pick up that phone and give us a call and discover what complete wealth management looks like. Ben and I are excited about the opportunity to partner with you and give you that financial plan that's going to make the next step so much better understood and get you where you need to go.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. It is a pleasure to have aboard with us Glen Dorsey. Glen is the head of client portfolio management at a little company known as Clarke Capital Management Group. And I say that a little tongue-in-cheek because Clarke Capital is not a little company. Maybe they started that way. But today, they are really known to us in the industry as one of the foremost places where people are going to generate income for themselves. And there's quite a few other services that I know that we hopefully have time to touch on as well with what Clarke brings to the marketplace and to advisors like us in our practices. But Glen is here to go ahead and shed some light on what's going on in the current state of affairs in terms of bonds and creating income as well as their portfolios, and what are some of the things that they see in the marketplace as solutions, as solves, as ways that we can come together for our clients and you today. Try to help bring some understanding to this. And Glen is responsible for portfolio construction. He's the guy that comes in to communicate investment strategy to us advisors, as well as you, our clients. And he's really an amazing resource that we have here with Clarke Capital and the investment consultants for financial advisors. So thank you so much, Glen, for joining us today. It's a pleasure to have you on Money on Tap.
Thank you, Seth. It's a pleasure to be here. Clearly, the environment that we're in now is unique and challenging from a fixed income standpoint. We've been blessed with interest rates declining from their peak in 1981, third quarter 1981. The 10-year Treasury was 16%, and we hit as low as 0.5% in August of last year, or pretty close to 0.5%. So while that generated a lot of capital appreciation along the way in the fixed income world, it's presented a new challenge, which is trying to invest in the fixed income world in a very low rate environment. And we're at a point where rates, there's been an inflection point in rates. We got down to almost 0.5% in August of 2020. And then when I'm talking about that, I'm talking about the bellwether U.S. 10-year Treasury, because everything else in fixed income space is priced around that. And, as of today, we're a little over 1.5%. So that's been a challenge to some degree in the short run for bonds, but ultimately provides a better opportunity set going forward as rates start to kind of gradually move up. There's a lot of concern right now that rates are going to spike up, and we're going to see tons of inflation. We don't think that's the case. We think we're going to see a modest increased inflation. We think we'll see a modest steepening of the yield curve, which is longer term rates moving up and short term rates not moving up much, which ultimately provides a better income stream for your traditional 60-40 portfolio, where the fixed income side can generate more in terms of income and not just the appreciation side. So it's kind of unique. We've never seen rates as low as we have in decades. So I think one of the things that investors need to think about in an environment where rates are moving up is that everybody thinks bonds are sort of one homogeneous group of assets, and they're not. Different subsectors of the fixed income space act differently in different environments. For example, treasuries, U.S. treasuries, only one thing moves their price, and that's interest rates. If interest rates go up, treasury prices go down. And if interest rates go down, treasury prices move up. But if you move over into the municipal side or the corporate side, or particularly the non-investment grade corporate side, they act very differently, because if rates are going up because the economy is improving, which is the environment that we're in now, oftentimes high yield bonds or non-investment grade bonds can actually go up in price because the risk of default has gotten smaller. And that's what we've typically seen in rising rate cycles. And so knowing where you're positioned in the fixed income world is hugely important, and as important as the general direction of rates or the general trends in inflation, which are obviously important as well.
Wow. So what I'm hearing from you right now is generally there's optimism coming in terms of the market in the bond world, in primarily that long-term, short-term differential there, kind of getting a little bit more separation there in those, which has been, what did we talk about this? I was trying to think if it was it 2019 or 2020 where we had the short-term, long-term crossover, and everybody went, "Oh my gosh, the market's gonna bail," or look out, here it comes. And we did a couple of shows even on that of what historically has happened in terms of bond, and it being these bellwethers to us, or these canaries in the coal mine to us of what could possibly be coming down the road. So that's really nice to hear some optimism there.
Yeah, to your point, the fixed income market gives a lot of signals that are very applicable to the equity market as well. And it was 2019 where we saw the yield curve invert. So short-term rates were higher than long-term rates. And the reason that sent off all kinds of warning signs and bells and whistles was that every recession that we've had in the U.S. has been preceded by an inverted yield curve. Right? There have been a couple false signals as well, and some people look at the 2-year Treasury versus the 10-year. We tend to look at the 3-month Treasury bill versus the 10-year because that's more reflective of Fed policy. I mean, the Federal Reserve, everybody always talks about interest rates, but the Federal Reserve directly controls short-term rates through the Fed funds rate and the discount rate. And back a little over a year ago when the pandemic hit, they lowered rates on the Fed funds to 0 to 0.25%. And so as we call it, ZIRP, or zero interest rate policy. So that has a lot of dynamics in terms of good outcomes for the stock equity market when the Fed is in this accommodative mode. And the analogy I use is that basically the Fed has its gas pedal all the way to the floor. And they've been pretty transparent about not changing that course for a while. So not only did they lower rates down to basically 0, but they've been in the open marketplace buying securities every month, which is that quantitative easing that you've probably heard about. So the Fed's balance sheet has gone from $4 trillion to north of $7 trillion over the last year. So that there's kind of two prongs of how they've tried to stimulate the economy. And what will likely happen is the Fed will stop buying as much as they are in the open marketplace. They'll kind of taper that off. We went through that after the Great Recession, where the market had the taper tantrum when they first talked about doing less quantitative easing. So that'll be the first step. They'll start to lower that amount that they're buying in the open marketplace before they start to raise short-term rates. Long-term rates are related to short-term rates, but they're not the same. Right. So the longer term rates are reflecting the future. All right. So if you think about a 10-year Treasury, you look at its yield at one point in time today and say, okay, it's 1.5 or 1.6%. But it's also, you can think of it as 2 5-year Treasuries, one 5-year now and 1 5-year 5 years later. Right. So it tells you a lot about what's being priced into the marketplace, and what is starting to get priced in and why longer term rates are going up is this really strong economic growth that we're having, which is fantastic for corporate earnings, fantastic for default rates and corporate bonds and non-investment grade bonds. But it's also priced in a little bit of higher inflation. And that's the word that's got everybody spooked. which is kind of funny or ironic, I should say. You go back 14 months ago before the pandemic hit, what was everybody afraid of? Deflation. The U.S. was going to become Japan. We were in this downward spiral where we're never going to get out of it. Here we are 14 months later, and now everybody's got us a 1970s style runaway inflation. It's possible that there's some gray area between the white and black of deflation and inflation that might be a healthier level of inflation. The Fed's been targeting 2% inflation for a decade, and they haven't been able to get it there. And finally, we're starting to get it. And it makes sense. As the economy reopens and more of us go out and spend money, and the supply chain isn't fully back where it is, you can see it in different goods where there's a backlog in production because the assembly lines aren't working at full speed yet. So there's likely to be an uptick in pricing that will probably settle down over time. But it does, to us, when there's activity in the market, volatility in the market, that's where we can add the most value. When everything is status quo and flat and boring, that's harder to add value. It's when you get these volatility events that it makes it a little bit easier to add value.
Glenn, I find that the onslaught of questions we have about hyperinflation, just hyperinflation, never less inflation. There's this paranoia that has gone, and I think you made a really good point about how we went from, one end of the spectrum all the way over from deflation, which I remember having a show about that, Seth, basically a year and a half ago, and the fears around all of that. And now we're in this kind of hyperinflation. And I definitely am in the ballpark where I think you're talking, and we had a conversation about this, a while back. Seth and I did a couple weeks ago. I think we did a show on inflation, and the Fed trying to target that 2% and seeing this as an opportunity to do that. But in order to get to that average 2%, they've really got to get that north of 3%, really, to be able to hit that 2% piece. Now, the backlog of it's a backlog of everything. Cars, computers. I went to Staples the other day to get a new printer for the office, and the lady was like, well, we have 30 printers for you to look at, but we have 4 on the shelf that you can buy. They just don't have anything. Can you bring this into layman's terms of how that backlog really brings together the inflationary events and the pricing component there?
Yeah, so that very much speaks to what you've heard the Fed refer to as transitory inflation. And what you're having is a surge in demand at a time where supply is not surging at the same level. So if you think about your old macroeconomics course, pricing is the intersection of supply and demand. So if demand is going up faster than supply, pricing is going to go up as well. Why it's transitory is that as more and more people get vaccinated and more people go back to work, the backlog in the supply chain will work itself off. And I think it's really important to distinguish the types of inflation that are out there, right? There's cost push inflation, which we had in the 70s and 80s, which was driven by energy prices, right? OPEC had control of oil prices. There was an embargo. Prices went through the roof. And if you think about the energy ripples through the economy in pricing everywhere. It's not just to fill up your gas tank. It's to heat your house. It's to heat your office building. It's an input in many, many goods that's energy price related to run an assembly line. So that as oil prices went up, prices of goods had to go up to keep up with it. Back then, there was a lot more collective bargaining agreements that had wages tied to inflation. So as inflation spiked up, then you had wages spike up. And that's difficult to get rid of. Commodity inflation, like an energy price, ultimately works itself out because, again, it's that supply and demand balance. If prices go up too much, you don't travel as much, right? So ultimately, demand will settle back down. That brings the prices back down. What we have today is very different, and this is demand pull inflation, right? So it's quote unquote the good inflation. It's reflecting strong demand for things. The supply will catch up. We're not overly concerned about that. And if you think about probably the best things to control inflation in the long run or unlimited pricing power, if you will, it's competition. Think about the corner where there are 4 gas stations. If you look at the price of the gas, they're going to be within a penny of one another, right? Because there's a lot of competition. Go 20 minutes away where there's one gas station and not another one around, they're going to be 10 cents higher because they can. There's no immediate competition. So if I look at the world today, pricing couldn't be more competitive, right? If you go to buy something, you go online, you plug it into Amazon or whatever, and you've got instant competition around the globe for the same thing, right? That to me is going to be a limiter of how much inflation is going to kick in. There's just too much competition to have prices skyrocket that much. Again, in the short run, will we see inflation go up? Sure. But if you go back to, we've gotten so used to inflation being non-existent, right? We forget history. It's always important to think about market history. Go back to the decade of the 90s. Inflation averaged 3% for the decade of the 90s. Stocks were up close to 18% per year, and bonds had good returns too. Go back to the decade of the 80s. Inflation was over 5% on average for the decade. Fantastic environment for stocks and bonds as well. So, everybody hears the word inflation. They get terrified and they run around. The sky's falling down. The reality is it's probably not that bad. I always say inflation's like taking your temperature. If it's too high, you have a fever. If it's too low, you're dead. So you want some inflation out there. There's a healthy level of inflation. I think that's what the Fed has been signaling, targeting. They're very rational, intelligent people, and I think that they've done a really amazing job of getting this economy up and running again. They're going to let inflation run a little bit hotter for a little bit longer to make up for the fact that they've been well under their target for 10 years. And that's okay. 3% inflation is not the end of the world. Would not upset us to see the 10-year Treasury over a period of a couple of years drift up, so that we get a higher coupon portion of our bond return rather than just price appreciation.
Well, I think that's interesting that you speak to the inflationary piece and how the market has done over those time periods, because that is a point that we have been trying to make, that inflation is not bad for the market. The inflation is bad for cash. If you have cash in the bank, that's really bad. Your spending power goes down. But, as inflation creeps through our economy, it actually ends up landing into your portfolio as a positive growth traditionally. And I think that's one of the things that people don't really understand is that, hey, I'm selling something for more money that's bringing my revenues up, that's making stock more attractive. People are reporting higher revenue growth. Therefore, more people want to own a company that's reporting higher revenue growth, which creates competition. And as you said, I think that's a great point. To ask or to extend that question a little bit further, Glenn, time. I mean, there's probably a lot of people who, including myself, and we're speculating all of the time, all the amount of time that's going to take for us to go from, a lack of things to purchase to a massive surplus. What type of time period do you see inside that kind of manufacturing delay? Where are we at with that? Taking all the components of the politics out of this, okay? I mean, just looking at, we're coming out of this pandemic. You mentioned people are getting vaccinated. Things are happening. Assuming nothing happens between us and China and there's a trade war, what type of surplus, when can we get to a surplus where you can go into the store and you can choose all the different printers that you want?
That is a great question. I guess a lot of it.
That's why I asked it, Glenn.
Give me the easy questions. Clearly a lot of it is dependent upon the path of the vaccines. I think I saw the recent statistics that 50% of the adults in the U.S. have received at least one vaccination at this point, right? So we're on the right track. If we get setbacks like where we had some adverse reactions from one of the vaccines that might slow that down, that would push the timetable out more. It'd be hard to quantify, but I would think that somewhere in the 6 to 12 month time period that the shelves should be pretty full again.
I'm looking for a specific day. Glenn.
August 19th is my best guess.
Folks, you're listening to Money on Tap. Joining us here today, we have the privilege of having Glen Dorsey with Clarke Capital. And if you haven't been really tuned into the conversation, we're going to have a lot of fun here coming up, just kind of throwing this around. It's inflation, it's bonds, it's income, it's the things that are really important, especially as people are investing and relying on the dollars that they put to work for them for a future outcome, ultimately probably income of some kind. And what are some of the ways that you need to be aware of this, and maybe some ways that we can hedge inflation? That's a little cue for you, Glenn, coming up next. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Don't go anywhere. We'll be right back.
Call us today at 855-226-8551 and get your free consultation with Ben Brayshaw or Seth Krussman or any one of our partners, and find out what's going on in your plan, your estate plan, your financial plan, or what you're planning at all, if nothing. Get it fixed, get it right, get it done today. Give us a call at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, today we have a real treat for us to be able to spend some time with Glen Dorsey from Clarke Capital. And Clarke Capital is one of those companies that we just have a lot of respect for. They bring a lot to the industry as far as their knowledge, their experience, and the service that they help us as advisors with. And Glen's jumping on here with us to help you out in talking about some things like inflation and bonds and all sorts of different things. One of the things that we were talking about was that bond inversion that happened in 2019. And as we were talking about that, I was like, wait a second. And then 2020 hit and we did have a recession. But did that count? Because it was completely out of nowhere. I don't know that we can even count that. I mean, we have to, but
I would say that was well, I guess there's no footnotes in things when they're right? So yeah, I guess right. it was right, but what we had seen was corporate profits had started to go down. There was some concern about the economy slowing down. It just got turbocharged by the pandemic, and I think the fact that the yield curve had uninverted and was coming back was suggesting that I think more people thought we were going to be able to get through without that recession, and it might have been a false signal, but it turned out not to be a false signal.
I guess not, right? Throw COVID in there and the market goes down, boom, your signals are accurate again.
34% in a month and 4 days. Yeah, that's a pretty good correction. Yeah,
no, absolutely. So, Glen, share a little bit about Clarke Capital, the nature of Clarke Capital, the type of I was going to just say tactical investment company that you guys are, and I didn't want to take that away from you. But if you could share a little bit about that and bring in, the space that you guys play in the most, if you wouldn't mind.
Yeah, sure. So we're independent family and employee-owned firm based out of Philadelphia. Started back in 1986. We've worked with independent financial advisors and their clients trying to provide investment solutions. One of the things that we think is important to keep people from making mistakes over the long haul and being emotional is to try to build in a tactical component to the portfolio. And what I mean by that is a measured tactical component. I think the mistake people make often or frequently is they run from one side of the boat to the other. And it's all, I'm 100% in this or I'm 0% in that. And we like to have a strategic, longer term portion of the portfolio that's qualitative, bottom up, good old fashioned stock and bond selection that stays where it is. You can make moves inside of those strategies, but you're not going to go from an equity strategy to all cash. But what we like to do is complement that with some of our tactical strategies. For example, our fixed income total return, or our tactical fixed income strategy, which can be in either high yield bond exposure treasury exposure or cash or short T-bill exposure. So it was kind of risk on, risk off, all the money off the table. And what it does is it uses a quantitative model that's based upon what the market's doing. And so, for example, last year during the pandemic, a pretty good example of what happened is we saw equity markets and high yield markets start to go down. They peaked in February 19th. By February 26th, we were 50% out of the high yield space because our model was saying there was weakness there, and we were on notice. And in early March, we got completely out of the high yield space. And the month of March was where the real pain was felt in the stock market and in the high yield space. Stocks bottomed on March 23rd, fixed high yield about the same time. By March 27th, we had moved back into the high yield space. So what we did is two things. One was protect capital on the way down, which is hugely important to good long-term returns. The other thing it does is it softens the blow. So in terms of the swings of the portfolio value, and that emotional component is important to keep people invested. Because they make mistakes when they see their account go down. We've all had the conversation of, I can't stand to see my account value go down another day. I need to get out. And what is that usually? That's usually the market bottom. Think about how everybody felt on March 23rd of last year. There weren't a lot of people jumping up and down saying, oh my gosh, I can't wait to buy. But what a quantitative model does, it takes emotion out of it. It says, what is the market telling us? And at that point, by 4 days after the bottom, our quantitative model was saying you need to get back in. That's where the relative strength is in the market, and that's what we did. But if you think about the importance of preservation of capital, just do the simple math. If you start at 100 and you go down to 50, you're down 50%. You're $50, right? How much do you have to be to get back to break even? You have to go up 100%. Right, so limiting that downside is a critical component of what we want to do with our tactical strategies, and that's really, I think, has served our clients well over a long period of time with our strategy.
Glenn, a couple questions for you specifically on the average investor who's listening to this today, saying, "Wow, I don't understand tactical. There's no way I'm going to be able to maneuver between bonds in the high yield space to treasuries to cash and know when to do that. And I don't have the time while I'm working my full-time job, but I got butchered in bonds this last year and, rates went down, my bonds lost value, potentially, or whatever the scenario is. Do you have any advice, general in nature, that you could chat with somebody about the bond market and how you feel about that and maybe directions to look for or things to keep in mind?
Maybe it's self-serving, but I think one important lesson out of all of this is, I think you said it, is that
besides calling Clarke Capital to invest your money, is that the self-serving part? I'm just kidding.
The self-serving part is, I think this investing is not a do-it-yourself part-time thing.
Agreed.
Most of our clients are very smart, educated people. They've done a great job of making money and saving money, but that does not make them an investment expert. Right. I've been doing this for 36 years. The average tenure in our team is high 20s in terms of our investment professionals. I know when, if you need legal advice, you don't try to do it yourself. You hire a good attorney. If you get somebody in your family gets sick, you don't treat them yourself. You get the best medical professional that you can to take care of that. And I think, having years of experience doing the same thing over and over and over again, so that we've seen this playbook so many times, it's really important to have a historical perspective. I've used to fly a lot before COVID. And, when I get on the plane and I look to my left into the cockpit, I want to know that they don't do this part-time and that they work at the Staples selling, HP printers, but they do it 10 hours a week and they like to fly the plane. So I think having investment experts and professionals is managing the money is really important. Our job is to be not emotional and focus on the fundamentals. And I think that's a really important component. I would not say try to do the tactical shifts in bond portfolios on your own.
Have you seen the Tracy Morgan commercial? He's like, I think it's for a mortgage company. He's like, I'm pretty sure. Let's look at pretty sure. And he goes through all these horrific scenarios that you just kind of went through with the pilot and the plane. It's like, yeah, no, I want a full-time pilot in that scenario right there.
I did see that commercial. It was pretty funny.
I got a question for you. We've talked a lot about inflation, and we've talked about the non-typical market that we've really been experiencing. It's something out of. It almost feels at times like it came out of a sci-fi novel when we were in the middle of this thing and moving through it. I mean, you name it. It was like the hypothetical. This could be, that could be, and it was. Technology became the instead of utilities, the place where everybody went for a safe return in their investment. Which just, I was listening to something the other day that just made no sense. How did that ever happen? And so I'm thinking about this inflation situation and good inflation, and that 3% would be great. But we're going to have the media telling us that it's awful and that the end of the world is here because 3% inflation is upon us. What are, the typical places where people go to hedge? And I think we have these conversations coming up more and more with clients is, are you going to go buy gold? Or the typical places again where people go to hedge, but then there's this crypto thing out there that people are trying to buy into and say, well, maybe that's the play that people should be hedging with. Where do you guys come from on this inflation and hedging that inflation piece inside of somebody's assets? And maybe it's a portion as anything really should be in a diversified place, but that I'd love to hear from you on it.
Yeah, historically, if you look at the best places to protect yourself against inflation are stocks, and particularly stocks that have rising dividends. Because if you think about the other term for bond is fixed income, right? What does fixed income mean? If you buy a bond today, your income from that is flat. As inflation goes up, it's eroding your purchasing power. Whereas if you buy a company that has a 2% dividend yield and they're increasing their dividend every year, your cash flow is helping offset the increase in prices that you're paying. So historically, stocks have been a pretty good place to hedge against inflation. High yield bonds, which is the non-investment grade bonds that we use in our fixed income total return strategy, where high yield bonds can benefit from that improving cycle. High yield bonds have the interesting characteristic of actually performing better in years when interest rates go up than they have in years when interest rates go down. There are not many places that you can say that. So I think that's a pretty good area to protect against inflation. But if anybody, I'll share my screen for a minute, and I mentioned, what some different decades looked like in investments. And again, if you look at the 80s where you had 5.5% inflation, an average annual return of 17.3% in stocks and 12% in bonds, right? You immediately think, 5.5% inflation. Oh my gosh, I must have lost all my bond money. Well, the reality is you didn't. In the 90s, you went to 3% inflation, had 18% annualized stock returns and 7.4% bond returns. Ben, I think you mentioned it before, the area that you're guaranteed to fall behind is if you're in cash, right? If you're not invested, you have zero chance for growth to keep up with inflation. So a thoughtful equity allocation that makes sense with what your risk tolerance is, because if you just look at the numbers, we all know that stocks are the best performing asset class over time, but they're also very, very volatile, right? Bonds, we call that your stay rich money. And equities you can think of as your get rich money. The returns aren't going to be as high typically, but there's a lot less volatility. So it's trying to find that balance. And we always say it's trying to build a portfolio with a personality that matches your portfolio. Right? We have clients that are professional athletes that are in their 20s that can take a ton of risk and don't look at their portfolio very often. We have retirees that are hyper-focused on it, and they can't stand the volatility. So we want to dial up and down that stock and bond allocation to try to get the right blend. But, again, in an environment where prices are going up, I think one of the only ways that you can think about keeping up with inflation is to have an allocation to stocks and is to have an allocation to bonds, not treasuries as much as corporate bonds. And if you think about, I always talk to our retirees that we talk to and say, at the end of the day, what you want to do is provide a stream of income that will last you the rest of your life before your money runs out, right? And essentially, that's the same a model as an endowment or a foundation has, right? They want to pay out X% a year and never go away. And when you look at their portfolios, what do they have? They have stocks in there. They have bonds in there. And it ultimately is the same model as providing an income stream and not dipping down and running through your capital.
Glenn, we talked a little bit about hedging the entire inflationary event. Can you go into a little bit more depth in that? I mean, we've chatted briefly offline about commodities and things like that. Can you speak to that a little bit more?
Yeah, commodities have historically done pretty well in inflationary environments, and they have in this economic recovery period as well. So the precious metals, the golds, the silvers, platinums have done pretty well. The issue or the harder issue to deal with those types of commodities as a hedge is that they're difficult to value, right? So when we value a stock or a bond, if we buy a stock, we're becoming an equity owner or business owner in that business, right? So what do we want to know? Well, their profits are growing, right? So what are we doing? We're looking at future cash flows and saying, what's that worth today? Right? Yeah, I'm a business owner. I want to participate in that earnings growth. If I'm a bondholder, I want to make sure that they have enough cash flow to pay me back. That's all I care about. So we're looking at cash flows and estimates of cash flows and say, what is that worth today? Gold doesn't have a cash flow associated with it, right? So its price is 100% determined by supply and demand. Are there more buyers than sellers of gold? If so, then that price is going up. If there are less buyers than sellers, then that price is going down. So, we used to, this is not a knock on gold because it's done well in certain environments. And, but the concept of assuming you're going to make money because somebody else is going to buy it at a higher price, we used to call the greater fool theory, that somebody's willing to pay more than I did to buy that. And that's how I'm going to make money. So, again, I'm not knocking gold. I know there's probably some gold bugs listening to this that are going to jump up and down and show evidence that it did well in some environment, and that's fair. But we can also say the same about the more traditional ways to hedge inflation, which would be dividend growing stocks and corporate bonds.
Yeah, and I think I would tend to lean on that side of this pretty heavily. I mean, we made some portfolio shifts. In some of our, kind of that traditional 60-40 equity to bond ratio, we created what we call our 70 portfolio in this last year, and we shifted a portion of our bond holdings to the kind of the large yield, high yield space in the equity marketplace in anticipation of that with, just it being so complicated to find yield and value in the bond area. And that has fortunately bode well for us this year. And it doesn't work every year, but those type of moves are important. And partners like Clarke Capital are huge for us, and we appreciate you guys very much.
Yeah, thank you so much, Glenn. It was a lot of fun to bring to the table some of the topics. I was thinking about the gold piece and the commodity there, and the last time that I really recall gold just going on a rip was the 08, 09 segment of our financial collapse. And if you think about it, if we're looking at a financial collapse, why wouldn't you buy gold? Because it's like the place where you can just be pretty sure that that's going to work no matter what. Today, I don't know that we're there. So consider that. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You can also find us at Facebook. We're at /3D Investing. We're also on Twitter at BFG_LLC. And as always, you can also find us at yourmoneyontap.com.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.